Hi, everyone. This is Jason Birack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for years. He is one of the top investing podcasts on iTunes. He used to be with Stansberry Radio, SN8 Radio. He's worked on Wall Street a long time. His father was one of the top value investor newsletters before there was the internet, and he used to speak with Warren Buffett. He worked with TheStreet.com and with Jim Cramer, worked on Wall Street, and he also worked at Stansberry, so he has a really great resume. I'm really excited to bring my listeners Frank Curzio. Thanks for joining us, Frank.
Thanks for having me, Jason. That was a great introduction. I really appreciate it.
Well, I really respect your work, Frank. You've really enlightened me to the technology industry. But before we get to the technology industry, I want to talk about the resource industry. You know, we've just had a really painful cyclical bear market, really since 2011. China slowed down. We've seen it look like gold and silver miners have bottomed, a bunch of different times since 2011. But now we're finally starting to see bankruptcies. We saw a pretty large gold miner. It was Allied Nevada. They've produced a good amount of gold and silver. I think they were considered a mid-tier producer. Do you think it's going to get worse before it gets better?
It is going to get a little worse, and I can tell you why. Even this past quarter, I looked at a lot of conference calls from the top miners in both gold and silver industries. And it's amazing because even in 2008, when we saw the credit crisis, if you look at the steel industry, right, it's like all the steel companies got in a room together and said, you know what, this is what we need to do. We need to slow production. We need to lower costs. Let's do it at the same time. You've seen a little bit go, the same thing happened with the oil industry, right? They were like, okay, we just can't produce at these prices. Production's going to come offline. They drastically, the CapEx cuts have been massive, never this big. In gold, if you look at these conference calls of some of these big guys, and even the mid-tier in both gold and silver, they're producing record production. Because there's still a little bit of margin. Their all-in costs are around $950 to $1,000, and we have around $1,100, $1,150 gold prices. So they're trying to produce as much as they can and actually take advantage of that small margin. But long term, it's not really that good for the market. So you'd like to see that supply and demand differential, reverse this way prices go higher, and we will see that in oil, and it might take 2, 3 years, 4 years. I don't know if we're going to see that right away in gold, but it doesn't mean that you can't invest in this industry. There's still a lot of good opportunities where, if you're looking at the rest of the market, how many sectors have you seen where stocks are down 70, 80%? You're looking at junior gold miners with great properties, I think are fantastic buys if you follow rules, like if you go in and follow management where they have a huge insider stake, they have good geography, they're located in good areas. If you follow some of these rules, these companies are trading 70, 80% down. And the insiders of those stocks and managers, they're adding to their positions because they're going to hold these things. They have enough cash to weather the storm, and they're going to hold these things for 3, 4, 5 years, hopefully when this industry gets better. So getting back to the original question, it could get a little bit worse only because these guys have not cut back on production on both gold and silver.
Yeah, and they made the mistake, like you mentioned, they didn't hedge. So we had a lot of shareholders, including myself at one point, because in 2011, I thought the Fed was going to lose control and we were going to have worse and worse inflation, but they managed to control inflationary expectations. And the gold and silver miners, they weren't prepared. They didn't, even hedge part of their production. They just were completely and totally unhedged. Whereas the CEOs in the oil industry, even though almost none of the oil experts and almost none of the oil CEOs saw that humongous oil price crash coming, at least they were hedged, right, just in case. So they had some type of insurance plan, some type of their cash flows were at least somewhat manageable to prevent a good amount of bankruptcies. So I have a lot of contacts in the gold and silver industry. I don't know if you're familiar with my work, but I've interviewed a lot of other gold and silver experts, Rick Rule and so many others, yep. And they basically tell me that the debt and the equity are not really available even at penalty rates for most of the miners now. So we've had a lot of critics say for the gold and silver miners that, there were gold and silver miners 10 years ago that were able to produce gold and silver at much lower prices, and they can do that and still survive. But the deposits and depletion, these mines that were brought online since 2007, 2008, 2009, they needed a much higher gold and silver price, and they brought these mines on with debt, and they weren't hedged. So we're going to see, I think we're going to see a decent amount of bankruptcies, and I think we're going to see some really bargain shopping here, fire sale prices for the prudent miners who actually have some cash or their stock price didn't fall as much. And I think those guys are going to come in and scoop up those projects like the ones you mentioned. And I also really like the royalty and streaming companies because those guys don't need debt to grow and they generate free cash flow.
Yeah, and you brought up a lot of different things there. I think the best investment right now is probably to go with Rick Rule, because Rick Rule is in a prime seat because he's the one that finances a lot of these companies through Sprott. And financing is very, very difficult, so these guys are willing to give away a ton. So say if a stock's trading at 15 and they need to raise money, they may do it at 13 and raise as much money as they can. They're not even able to do that. So what they have to do is give away warrants. And I'm seeing warrants, 5-year warrants being given away now. So if you could actually buy these stocks at a 10, 15% discount and try to get into these secondary offerings and get warrants for 5 years, you could just sit back on this stock, put it away. I mean, it's a different ball game, but it brings – you brought up a lot of good points, Jason, where it's so hard to raise money and these guys are in trouble. But if you actually have access to capital, you're really king in this industry because everybody's coming to you. They need it. They're in a lot of trouble. And like you said, the word hedge, you know, when you're looking at the oil industry, who do we see take their hedges off? Harold Hamm, around $70, you know, for Continental Resources, the biggest player in the Bakken, a place that I visited. You know, when you see hedges come off, you have to be careful because we all get it wrong, right? I mean, everybody wants to talk about their winners, but we always get, you know, a lot of times we get it wrong. Even Warren Buffett has been wrong on IBM. You look at David Einhorn, who's been wrong on Green Mountain Coffee. Ackman has been wrong on Target. And those are the 3 greatest investors ever, in my opinion. So when you see unhedged, it's very dangerous. And now you have Harold Hamm on TV, on CNBC every day, you know, trying to – change the laws of oil that we should be exporting oil because he has no choice, you know. So that's one way to look at it. When people say they're unhedged, it's very dangerous because you could always come into a market like we saw with oil, right? I mean, how crazy was oil? Nobody expected $40. The only people that predicted 40 were the people that were predicting 40 for the last 5 years and have been dead wrong. But when the prices were coming down, I thought, well, maybe 70, 65. And like you, I got on the phone with my contacts and they said, look, a lot of guys are hedged in this industry. They're going to be in a lot of trouble. And I was like, wow, this is going to get a lot worse. So you have to really be careful even buying oil companies here because they are hedged, and they're hedged only for the next 6 months to the next year. Maybe it's $60, $70, $75 oil prices. But what happens when those hedges reset? Now you're going to have a lot of trouble selling that oil. You got to go down to 50 now where it is, so maybe 55. So just be careful buying oil companies long term because you're going to need those oil prices to go higher.
Yeah, I think this oil price is unsustainable, but, you know, my crystal ball is kind of broken, and I can't tell you exactly when the oil price is going to rise, just that sometime in the near future it's going to have to, because only the Saudis are really making any money here. The private sector guys, they're only making money if they're hedged. But you brought up Warren Buffett, and Warren Buffett, the worst investment of his career was actually ConocoPhillips when, you know, he saw the oil prices going higher, and I think he believed hardcore in peak oil, right? And he bought, I think, ConocoPhillips at like $80 or $90 a share, and he then sold it at 40. So, you know, it's something that he's not really a commodities expert. Natural resources isn't really his forte. He focuses, you know, on consumer. You as a value investor, you know, he focuses on the consumer, closer to the consumer products. But you know, he got excited in the oil market, and he got burned too. But now, you know, he has that he has the railroads there, and he's making the monopoly money off the Bakken railroad transport.
Yeah, no, and like we said, I mean, we're talking about a great investor here that happened to get a couple of things wrong, and that's why you really need to protect yourself. So, you brought up a good point. When you hear that word on hedge, at least for me, it really scares me. It makes me pretty much avoid the stock, and even with Continental Resources, it's not on the top of my list. The fact that, you know, they took off their hedges. What was it, $70 or something? And now look where oil prices are. They're going to be in big trouble if this continues. And they took, you know, they were short basically with the hedges, so they were able when they basically sold that hedge position, they were able to bring in like over $400 million. So they're okay for a little while bringing in that cash, but long term, they better hope oil prices go higher.
Oh, I think they will go higher. I think we're looking at 65 to 90 as a new trading range, but I don't know how long it's going to take to get there. So it could be, you know, 6 months, could be 12, could be 18, but we're going to have to go back there so people can make money. Otherwise, you know, we're going to have governments collapse. We're going to have Venezuela collapse. We're going to have when the hedges expire off the shale oil producers, either they're going to have to merge and, you know, sell equity, which they can't because their stock price is down a lot. We're gonna have a painful consolidation and a lot of supply coming offline. So one way or another, Frank, I think this will be resolved probably in the next 18 months. But I can't tell you if it's going to take, you know, a couple months or 6 months or 12 months or the full 18.
Well, you know, and be careful with the 18-month prediction, only because I've made that mistake. And you may be right; it may take 6 months, but prices could trade irrationally for a very long time. And people say, what's the average price for oil? Well, you know, if you go back and look at the models on a lot of people have been covering oil for a very long time. It's around $75 when you pull it out of the ground, when you store it and everything. It turns out to be around $75. It's a general number, but this is from like 20 different models that I looked at from guys who've been covering this industry. If that's the case at $75, we stayed over $90 for 4 years. That's kind of irrationally high, so why can't we stay irrationally low that long? And a good example, too, is at the end of 2008, the beginning of 2009, at the end of 2008, you had some of the greatest investors saying, I've never seen valuations like this in my entire life. And they were right long term. But people forget that the market really crashed from January to March when we hit the 666 bottom on the S&P 500. So, and then that turned out to be the ultimate bottom. So it just goes to show you, like, sometimes, and me, when I made those mistakes too, I'm like, wow, this doesn't make sense. Sometimes they can go down even further. It could be even more rational. That's why I'm a little bit more, I'd rather see the price come back before I actually start investing in it and see the trend in our favor than just saying, hey, you know what, it could be 6 months or 12 months. But, I agree with you. But, just for the audience out there, you have to be very careful because I've been wrong, a few times just thinking that prices, hey, this is a good time. Even with mining last year, I thought September, October was a great time, and I turned out to be wrong. And now I think it's even a much better opportunity.
Those are great points, and that's why you can't go all in. A lot of people want an easy strategy where you try to get to the bottom and you get it right, but then that's gambling. That's not really investing. You're not averaging into a position. So even if you think it's the bottom, you buy a partial position maybe, or you have some kind of risk management with a stop loss, or you save cash on the sidelines. So if it goes down on a discount, you buy more. And the greatest value investors, whether it's Buffett or Benjamin Graham, those guys preach that. They preach risk control and not going all in on your position at once, no matter how much you like a company or a sector.
Some of them do, Jason, but I got to tell you, being a value investor for a very long time, a lot of them don't use stop-sell disciplines, which I think is the worst thing you could possibly do because you have the ability to be really wrong on something and something that you like when you get excited about. Sometimes it doesn't – even in oil, for example. We keep using oil as an example, but even whatever stock it is, maybe it's a mid-cap stock. And look at GoPro, right? I have a GoPro camera. I think it's great. I went to the Consumer Electronics Show this year, and even last year, everybody's making these type of cameras now, and they're all integrated. Like you talk about Sony, Apple's looking to do it. So this company's really getting hit hard with a good product, and maybe you're wrong on it, and it comes down. But sometimes value investors are like, well, if I see the value there, I'm not going to sell out. I'm going to look to buy more. And you have to be very careful with that discipline. I mean, when for the individual investor, it's really tough because you have to admit that, listen, you're buying a piece of paper, you're buying a stock, right? You're buying a company. There's no emotions there. There shouldn't be any emotions. If your thesis changes, you have to be willing to either sell the stock or at least put a stop loss on it because instead of thinking about that stock in your portfolio, it's down 70, 80%. It's going to, believe me, I know, unfortunately, not 70 or 80%, but I've had big losers. I keep talking about my losers here, right? But, it messes with your head, and it's the only thing you think of the whole time. Instead, you stopped out of a stock, no emotions anymore. Say if you have a 25% loss, now you're looking at different ideas, especially when a whole market comes down. You could look at the oil industry right now and start analyzing companies saying, wow, if oil does go back up to 60, 70, these are 3 companies that are going to benefit. Instead of being down 80% of the stock and being like, man, what do I do? Should I buy more? It's really important to have those risk management disciplines. A lot of people, even some value investors that I know, just, they analyze the books and say, well, if it goes cheaper, that means it's a better buy. You have to be very careful, especially in this market. You should have some kind of sell discipline and risk management techniques in place.
Those are great points. And, you brought up there's always the value trap. So for value investors, so if a company is paying a dividend and it looks like a juicy yield, we don't know if the yield's sustainable based on the oil price and their hedges and things like that and how much debt they have and if they can restructure the debt or when the debt's due. So there's a lot of different factors besides, just seeing that so-and-so company is paying so-and-so yield and I should go buy that company. There's more due diligence required to see if if the yield is sustainable and it's a good investment and you're going to get paid to wait and things like that.
Exactly.
I think one of the good companies for the resource industry, and you brought up Rick Roll, is actually Sprott itself. So if you don't want to go out and buy an individual mining company or a royalty and streaming company or gold mining ETF or things like that, you can go buy Sprott itself. And the people at Sprott, they pay you over it's on the Canadian exchange, the Toronto exchange, pays over 4% yield, and they have lots of people there to do the due diligence for you, and their portfolio is highly leveraged with quality resource assets. So when the gold and silver prices and the oil prices do turn, they're going to make a lot of money.
Yeah, I know. And I'm a big fan of Rick Rule. I've known him for a very long time, just like yourself. And, he's been there for, he's been doing this for 40 years. even longer. I won't say any longer because it makes it sound like he's really old, but he's not. But, he's been through these ups and downs, and I can tell you it's a crappy market. Everybody knows it. It's horrible. But this is how Rick Rule made his fortune. This is how guys like Jeff Phillips, Maren Caduceus made their fortune when they're going all in at a time when everybody else is selling. And it's so bad out there. And right now, the deals that they're getting where you can get 5-year warrants and secondary offerings and just, really load up on stocks with great management teams that have a stake in the game and insider ownership and holding these things. This is how they made their fortune. This is what interests me in this sector because I'm not 100% invested in this sector. So I've been part of this bull market and been bullish for a very, very long time with low interest rates. I think the market's continuing to go higher as long as interest rates remain low. But if you look at the mining industry and you talk to executives, they're really down. Like and they should be because it's been a horrible market for 4 years. But for me, I'm looking at this market going, wow, I want to buy these stocks, hold them, make sure they have enough cash, forget about them for like 3-4 years. And this market turns, you're not going to see 50%, 100% gains. These stocks go up 1,000% when the cycles turns. And that's how Rick Rules and all those guys, guys who've been around for 20, 30 years, made their money in the mining industry.
Exactly, and it's not just going to be those gains are not going to be tiny, but they're going to require people to not check their account every single day, right, and panic, oh, it's down a little bit, right, when you just got to have that mental toughness, that discipline to know that, I'm looking a couple years out and I'm not putting all my money into one company and, I'm going to be disciplined. This is a long-term play. I'm going to let things play out over X number of years, and, I've done my homework here. So that's the thing about long-term investing. It requires patience. It's much easier said than done.
Yeah, and just to bring it together, even with stops, and people would say, well, Frank, if you use stops, you're probably going to stop out of this industry. It's so volatile. But, it's so bad right now in the mining industry. You have a lot of these great companies, not many of them, but a lot of great companies trading near cash. So if you put your stop loss and it happens to be 25, 30%, and you put it below the net cash level, now you have a nice cushion, right? I mean, if it falls below cash, it usually doesn't happen. When it does, you usually see in all kinds of industries, even biotech, as long as they're not burning through that cash like crazy, you'll see that stock pop up a lot higher. So right now,
or a buyout candidate, right? Because then if you're an acquirer, right, you're going to get that cash rebate.
Yeah, you're going to get, and it depends on the property and how much money you're spending. Because if it, you could trade below cash, yet the only property that you own may take $1 billion to develop. So then it doesn't make sense. So you have to get a little more into the research. But when you're following guys like yourself or Rick Rule and stuff like that, and guys who know the industry, when you put that stop loss below that cash position, you analyze the company and say, look, these guys have enough cash to last for a while. These guys are doing good. You're looking at 35%, 30%, on a stop. And if the cycle turns, you're looking at 1,000% gain. I take that any day of the week. That's a great risk reward. So that's what you're seeing in the mining industry. Maybe a lot of people aren't familiar with it because they're just making so much money in the biotech industry, which is amazing, and so many other sectors in technology. But it's an area that I've been focused on. I've been doing a ton of research, a ton of traveling, talking to executives, and starting to pull a trigger a little bit on some of those junior miner stocks.
Now, I think that's great analysis, Frank, of the resource industry. I want to transition now to the next topic. You cover the technology stocks. I don't cover these as much as analysts like you do. Mark Cuban came out and said something very interesting recently. I think it was this week. It was the technology bubble's worse now than in 1999. Do you agree with him about that?
Yes and no. I think the private equity market in there, the private market in technology is insane. I mean, you could have a good technology, and if they don't think it's going to be $1 billion, they're like, all right, forget it, I don't want to invest in it. And that's kind of what we saw in 1999, like Uber's valuation. You've seen so many of these other private companies, the valuations are insane. They're like, or $20, $30 billion, $40 billion based on the latest capital raise. So after they raise capital, then you could basically give them a valuation of what they're worth. And on the latest capital raises, I mean, some of these companies are crazy. And I'm going to tell you, Jason, in terms of technology, too, you have to be very careful because you look at Alibaba and it comes out. And I'm not even saying this because it went up. And the reason why it went up towards the end of the year is hedge funds were basically underperforming. And that was a great stock. It was a hype stock to get into. And now, they're taking their gains and it's falling. But you have to realize the market today, the way you make millions of dollars is by investing in these early-stage companies, the private equity market. You don't want to invest in Alibaba now when 90% of the growth potential is gone, right? All the growth took place in the last, 10, 15 years, all those capital raises, all those guys, they're looking to cash out in this IPO, and it's so sad that when they, it opens up and it's a big deal on New York Stock Exchange, people are like, oh, Alibaba, I want to get involved with it. Don't get involved in it now. I mean, you're looking at a company, seriously, 90% of its growth is gone. And that's why you're seeing, so much more money go into the private market. So I think Mark Cuban's right there. On the other end, there's so many great technology companies out there. I don't think it's a bubble. I don't see it that expensive. You're looking at 45 times earnings that the NASDAQ was trading at back in 1999. And people forget. He should remember. If he doesn't remember, it's because he got very, very lucky selling his company at the top. He just got a great offer, became a billionaire, and I don't even know if that company still exists anymore, whatever, broadcast.com or whatever it was.
He knew the top was in, though, so he collared his stock position, though, smartly, unlike, almost any of the other people who sold their companies. He collared his stock position and cashed out on the gains.
Yeah, which is, again, and I'm a huge fan of Mark Cuban, and, but right now those valuations aren't even close to where they are where the NASDAQ is, and we have a very low interest rate environment, which is important because you're going to see money continue to flow into stocks. And not only that, with technology, the whole entire world is getting connected. Bandwidth is becoming faster. You're looking at the Internet of Everything, which incorporates what? Big data, which is, this is a monster trend, analyzing and be able to predict future patterns of people. I mean, you have to do the research on this. Don't even listen to me. Go on Google. Just put in big data. I mean, they're able to tell and predict future patterns. It's unbelievable. If you heard the story of Target where the manager at Target, the retail store, basically was, one of the main guys had this algorithm to predict when women were going to have babies, right? When they were going to get pregnant. So, this dad came in and, his daughter's a teenager and he went into the store and yelled at the manager, said, "Why are you sending this to my daughter for? Why are you sending these things to buy baby furniture and all this?" So he's like, "I'm so sorry," whatever, right? So a week later, the manager from Target calls this person back, calls his dad back and says, "Look, I just want to apologize again." He's like, "No, I need to apologize to you. You're right. My daughter's actually pregnant." So
Target knew before.
They knew when the girl was pregnant, almost to the date, and knew when she was going to have the baby based on what she's spending. This was 5 years ago. This happened before 2011 happened. So think about where the technology is now. It's amazing. It's a trend that I'm looking at. So all this data is getting analyzed, and you say, "Well, what do you mean?" Well, look at Facebook, right? I mean, how many of you listening to this, you put your whole life on Facebook? Even me, right? I post on Facebook too, and you post on Twitter. All this data is being analyzed. It's going through algorithms. They're going to know when you're going to go to Las Vegas. They're going to know when you go to Dick's Sporting Goods. They're going to know they're going to be able to send you coupons. I mean, it's all being monitored all the time. And it's a monster trend because there's so much information out there. And then you look at, connected devices. Right now, 1% of the world is connected. I mean, you think about that, right? That's according to Cisco. You say 1% of the world. We're not just talking about cell phones and tablets. We're talking about the smart home. We're talking about appliances getting connected. Every car is going to be connected. Everyone's going to have 6, 7, 8 different devices connected. There's a lot of opportunities for what? The companies like Skyworks Solutions, a company I recommended at 27, it's almost 100 now, because they make the parts for all these companies to get them connected. So they're in the iPhones, they're in Apples, they're in Samsungs, they're in everything. So I don't agree with him that it's in a bubble. Some of these stocks are expensive, but even after a 250% run-up in Skyworks, it's still trading like 16 times earnings. Huge growth ahead. So there's a lot of trends within technology that are going to be huge. And I don't agree. I think, maybe it can come down a little bit. And some stocks may be crazy, like some of the social medias, maybe like Twitter. I think Facebook's still a bargain here. But I don't think that it's anywhere near 1999 where, I lived through that. People forget that companies were going up 700% on their IPOs, and they had like 3 web pages with zero revenue projected for 10 years. It's not.
Did they even have a business plan?
No, there wasn't even. All you had to do was put .com, and its stock was up 1,000%. I mean, there was like $8 billion valuations on companies that had a web page that didn't even work. So people forget 1999, and it was crazy. I don't even think we're near that. I think these companies are a lot smarter with their business models. Is it a little expensive? Some companies are, but I still see a lot of value in technology.
Yeah, I agree with you there. I think there's definitely some sectors of technology that are overvalued. You look at cybersecurity; it's in an enormous bull market. Governments are attacking each other. There's corporate espionage. There's identity theft and security fraud. But the valuations on these stocks, like they have obvious tailwinds in a bull market. But as a value investor, I don't want to pay 100 times free cash flow multiple for these things. I want these things to have a really nasty correction where all the trend traders and the momentum chasers just give up on the stocks for a little bit. They don't buy the dips, and then maybe I'd take a look at those. but there's just so many different technologies, whether it's robotics or 3D printing. But the valuations on some of these companies are like, there's dating apps out there, Frank, like Tinder and things like that. They have no business plan really to make any money, and yet, they're trading at tens of billions of dollars. So there's a few examples, I guess, here and there of like 1999 bubble-like stocks, but I think most of them are not drastically bubble-like stocks. I think there's more better business models, I would say, than 1999. There was only a handful of companies back then who actually had good business models, but now there's companies that have better business models.
Yeah, well, let me ask you a question about this though. From a values, I was fortunate enough where my late dad was in this business all his life, pure value investor, and then I went to work for Jim Cramer for 5 years, pure growth investor. And then I was able to basically take those two models and integrate something to make it my own, to say, okay, learning both models, this way you're not 100% pure value, 100% pure growth. So, and a good example of this, and I want to ask you a question, what do you think of Apple here? Do you think Apple's a good valuation?
I think it's a good solid dividend stock. I don't know, if they can keep growing at the same rate, but I think people are going to get a very solid value investment here, and there's going to be solid growth. It's not going to be spectacular. I tend, as a value investor, not to be fully strict numbers oriented. I tend to also look at sentiment, and I also read Sir John Templeton, so I try to look for value where there's negative sentiment. And there's a good, reasonable 5-year growth projection estimates, too. So stocks like, 3D printing, where they were drastically overvalued a couple of years ago, they've come down an enormous amount. I think 3D Systems has come down from like 80 to like 30-something.
Yeah, it's been crazy.
Yeah, so I think long-term, 3D printing, I'm very bullish on it. It's going to disrupt a lot of different industries. But, I don't know if the stocks are going to do anything for a little while, but I think long-term, I'm very bullish on 3D printing. So that's kind of my view of undervalued growth stocks that way.
Yeah, and even the point I was going to make with Apple right now, if you look at Apple's trading about 16 times earnings, if you back up the cash, you could say 14 times earnings, and I think it's a great time to take profits on Apple because that growth is going to slow dramatically over the next 2 years, and that's not my opinion. That's the 50 analysts that are covering it. Right now you're seeing 33% earnings growth because the new iPhone was just released. In a couple of quarters, they don't have that iPhone anymore, and every one of their markets aren't really as strong. They're all like single-digit growers, and even the markets are going to get into aren't that big because you talk about a company that's expected to generate $250 billion in revenue every year. And if you look at even the markets, a smart home market is supposed to be like $30 billion. You're looking at Apple Pay, they're supposed to generate $2 billion by 2017, which I think is a fantastic technology. So, I just think it's a good time to take profits on Apple, even though it's a good value. But when Apple was a really good value? In 2004. And the stock traded for 60 times earnings. If you look at Netflix in 2004, it traded like 80 times earnings. Celgene, 100 times earnings. Netflix is up like 5,000%. You look at Apple's up like 400%, 500%. So you're looking at these stocks and you say, I don't want, as a value investor, you look at the PE and it scares the hell out of you when you see 50, 60 times. But you have to look at the markets and the potential that these guys have to get into. And if you look at Apple's market and how they were going to get into China Mobile, 700 million users of phones, right? So you're looking at, in 2012 with Apple, would they sell 125 million of phones? So they're about to enter the Chinese market, right? They're entering 99 new countries. So if you could really dig into your research, and the only reason why I'm telling you this is I don't want you to pull up a stock for your listeners out there and they see 100p or 50p or 75p and they're like, oh, I'd never touch it. Dig more deep. Understand why is Netflix trading at a premium for? And I was wrong at Netflix at the beginning until about 3 years ago or 2 years ago when I went to the Consumer Electronics Show. And then I got it. I understood. Like I told everyone at 200, at 80 or 90, I didn't like Netflix. I thought it was horrible. At 200, I loved it. And what is it, like 400 and change now? Because I realized with Netflix that they weren't competing with the cable companies. Every single cable company is competing with Netflix. Every TV that you buy, forever going forever, as soon as you turn it on, it's a smart TV. It's going to have Netflix there. So I didn't get it, and now I actually get it. So when you look at the PEs, don't automatically run away. Look at the growth patterns. Look at the markets that they're in. How big could they get? Even Netflix, if you look at the cable companies, they all have $100 billion valuations. So they could take a lot of business away. So that's how I look at it with growth companies where, Apple was a great buy 2004. Nobody bought it. Today it's like 16 times earnings. They're like, wow, it's a great value. Now they're going to buy it. You know what I mean?
Yeah, and the PEs are, the current or past looking statements. You're looking at past. You're not looking at forward PEs or any new products and services. So there was reasonable projections there that if you tried in 2004, Frank, if you tried the iPod out and you saw maybe you went to Apple headquarters, if you're allowed to go there, and you saw some of the products they were testing, that they could, hit on some of these other products, and they were going to create whole new markets and basically monopolies for a while. So and this is the difference, between being a pure Buffett or Buffett or Benjamin Graham value investor, or incorporating, Sir John Templeton, where Sir John Templeton looked for, hated stocks with reasonable valuations, but then he tried to project, 5-year growth plans where if the company is going to come up with new products or services, create extra revenue streams and stuff like that. So that's kind of the difference. I'm not pure Buffett and Graham. I like John Templeton's work a lot too. I think he's a very one of the best investors ever.
Yeah, and feel for whatever, whoever you like out there, or have, and even I have my favorites out there like Ackman and Einhorn and stuff like that. But even if it's like Whitney Tilson is a student of Warren Buffett, Whitney Tilson bought Netflix at like $125. I mean, if you look at the fundamentals on Netflix, you're out of your mind buying it at $125. It's over $400 now because he was able to understand the market and look at the fundamentals behind the entire industry, that how much business could Netflix take away from everybody. So, that's what I'm trying to – I'm not saying buy every stock that's 100 PE. Just if you see something like that and the stock's trading, there's a lot of hype behind it or whatever, just understand or try to find out why that stock's trading for a premium. And most of the time it deserves that premium because they probably have the best technology in the space. They're probably number one in the industry. And the stock's probably going to go a lot higher because they have that position. They're going to continue to take market share in a market that could be $500, $600, $700 billion. And you're looking at a company trading at a $2 billion market cap, and yet it's trading at 100 PE. And you're like, oh, this is insane. But, when you look at the whole market as a whole, it may be a good buy. So that's how you combine value and growth, if that makes sense.
Yeah, those are good points. And I think 3D printing is a good one. But you mentioned the Internet of Everything and the component parts. Are there any other types of technology industry or sectors you think of have major tailwinds and they can continue growing their businesses and have some type of moat?
Within technology?
Yeah.
The big data trend I've been following, the Internet of Everything I've been following, cloud is getting bigger and bigger. But these are trends that, when I talked to someone from Ericsson, and they were very big in cloud 2 years ago, this is what I love to do. I hate talking to this. I talk to a lot of CEOs of companies, but they're going to tell you exactly what they want to hear, right? I mean, if you ask a CEO, hey, they're not going to say, well, you know what, don't buy my company right now. It's not, no CEO ever. I've talked to hundreds of them. When I went to speak, I don't know if it was at a conference or whatever, but I went to this Ericsson booth, and there was a guy there, older guy, and I said, how long you work for the company? He's like, 30 years, I've been here forever, and blah, 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 great guy. And I said, let me ask you a question. Where do you think cloud computing is in terms of what inning it's in? He goes, we're not even in the first inning yet. And I thought that was fantastic. And that's when I started, reviewing everything. This is a regular guy who's been in the industry for 30 years. This guy knows everything about everything, saying, look, and he's not talking his book. He's not talking, it's not like you're talking to the CEO. He was just like, you got to, he was really going into it, getting excited about it. And this is what was an older gentleman getting excited about this trend. So you look at some of those trends and you say, well, are those the only trends? I mean, one of the biggest things, too, I think maybe the biggest trend in the world right now may be the industrial internet. GE is at the forefront of this. So if you get a chance, go GE industrial internet. What that is putting sensors on every single machine in the world. This trend is going on right now. They're doing it in hospitals. They're doing it in the airline industry. They're doing it in the railroad industry where they monitor the locomotives, the bearings. They could understand if anything goes wrong, they could avoid derailments. You're looking at these sensors. What they do is they're sending millions of data points each day to a supercomputer, and then all through these algorithms, they could tell you, a whole bunch of new data, and that brings big data into it. So when you're looking, there's trying to say that it's trying to stop, airplane delays, right? Delays are horrible for us, and we hate it. We complain. They're 10 times worse for the airline industry because say if they delay it or say if they even cancel a flight, what happens? They got to give you vouchers. They got to put you up at a hotel. You got to come back the next day, rescheduling. It's really a pain for them. So by monitoring as much information as you can, if there's something wrong with the plane before it lands, instead of being on the runway for 2 hours, they could fix it while the people are coming off the plane. Traffic lights and signals and stuff like that. This way there's no more traffic. So GE is calling this trend a $32 trillion trend. I've never seen trillion out there before. $32 trillion trend based on the productivity, the amount of money companies can save. They're just starting to have conferences on this, and it gives GE finally a growth model, right? Which, for the last 2-3 years, significantly underperformed the S&P 500. Now you look at GE, they're really getting into the sensor business. They're putting sensors on everything that possibly is electronical and moves and monitoring this stuff. And there's a lot of great plays on this trend. It's still very early. It's in its infancy.
That sounds really interesting. I wasn't aware of that. All that many sensors. I've heard Mark Cuban talk about sensors, but I haven't heard him talk in depth about that. But that's probably what he's talking about. But it doesn't sound like Frank, our feeble human brains can account for that many, watching that many sensors. So we're going to have, machines do it more, whether it's robots or, artificial intelligence programs or things like that, monitor all these different sensors, because it's just going to be too many variables and things for us to watch all these things.
No, absolutely. So I think you got to buy the companies that do watch those things. And there's a lot of companies out there that I've recommended in my newsletters that have a great future in front of them and huge growth. That's why I don't think it's really in a bubble if you're investing in the right stocks at the right time, obviously, but in really good growth trends. That's how you avoid value traps. You want to avoid a value trap, make sure the stock that you're buying that's dirt cheap has a growth component. If it doesn't have a growth component, don't buy it. 9 times out of 10, it's going to be a value trap. So don't just buy something because it's cheap. You want to see a certain amount of catalysts that are going to happen 6 months, a year, 2 years down the line. That's the best time to buy these things because and I'm speaking from experience because I've made these mistakes before. So I like buying stocks like GE. I like right now because it does have that growth component. It's a value stock, pays a dividend higher than the S&P 500. They spent a ton of money to get involved in this trend. Now they could actually get into this trend. So I really like GE here. I think it's going to be a good performer over the next 2-3 years, which has been a horrible stock over the past couple of years because they finally have a great growth component that they could work towards.
That's interesting. And the last topic I wanted to talk to you about was actually dividends. We've seen the Fed do financial repression where interest rates are artificially low. It's forced savers and people who are looking to make up, either they're retired or they're looking to make up some of their lost income out into the higher end of the risk curve. They used to put their money in money markets or in savings accounts and get a higher interest rate. But now they seem to be going into master limited partnerships or into the stock market. And the valuations for a lot of these dividend stocks, there are a lot of these large cap stocks that really don't have any revenue growth. They're trading at very high P ratios and they don't have that growth component, like you said. Do you expect this trend to continue where the market's just going to keep paying higher and higher multiple for dividends like that with companies with have very little growth components?
I do think it's going to continue as long as you have low interest rates. And it's frustrating because people buying McDonald's at $100, I think, is insane. Yet, they can go outside, they know McDonald's, they've eaten there, whatever, they know it's not going away, and they're right. But here's a company that's going to have a lot of trouble growing its top line. Plus, they're in, they have to change their business model, right? I mean, we're growing up, even with Mike. When I was young, you go to McDonald's. My kids, I really don't take to McDonald's often unless, it's spur of the moment and just, we don't feel like cooking in my household. But they're going to have to change structurally because, there's a lot of things going on. People are more health conscious today. So you're looking at a company like that and a company like Procter & Gamble trading at, 19, 20 times forward earnings. Instead of doing that, and I'm not saying that you should sell those stocks and get out of them and short them. They're still going to do good as long as we have a low interest rate environment. But for me, I'd rather own a stock like Disney. And you say, well, Disney took off. It's over 100 now. The new Frozen movie's coming out and stuff like that. But, if you look at Walt Disney, it's trading at 18, 19 times forward earnings. So it's cheaper than Procter & Gamble. They have so many growth components. I mean, the Frozen franchise generated billions, probably, $1 billion in the movie theaters, but billions. They're going to come out with 20 Frozen movies. They're going to come out with 20 Star Wars movies. I've lived in Florida. I've been to Disney. This is, we like to go when it's not peak season because we got, we live in Florida. We have the annual pass. The parks are more crowded than ever. It doesn't even matter where you go. So people are still I mean, if you look at Disney, that's what you want to do when you look at these dividend stocks. You want to say, you want to compare them and see which ones are the best. So for me, I don't want to own McDonald's. I don't want to own Procter & Gamble because, like you said, there's very little top-line growth there. Disney has top-line growth. Their earnings growth is going to be huge. They have a ton of catalysts. You're looking at AT&T. I like it's been a horrible company for 2-3 years. They've finally added a growth component when they take over DirecTV later on this year. They're going to generate enough cash flow. They pay a 5% dividend. Integrate that business. It's going to be fantastic. Billions of dollars in synergies are going to save. So AT&T's been spending a ton of money on Spectrum, and it's, it just killed their stock price. And even GE, too, the last 2 years. For me, I like GE, AT&T. These are companies I think are going to do very well. And Disney, compared to Procter & Gamble, compared to McDonald's, and even Apple, which, I've been bullish since 2010 on Apple. Right now, that earnings growth is going to slow dramatically. next year and the following year, and you might have another quarter or two that are good. But remember, the iPad market is declining now. You're looking at, Mac single-digit sales. Again, they have to generate $250 billion in sales, and I know the headlines are great. They're coming out with an electronic car in 2020. It's going to be really difficult for them to meet that number in 2016, 2017 without their signature product, which is the iPhone, which just came out. So I'd rather go with the ones that are growing with those dividends than the ones that are not growing with those dividends, and that's how I look at that industry.
Yeah, and I think Apple's iWatch, it looks pretty, but I think it could be a flop. I think, a lot of these gadgets, whether it's Google Glass or stuff, I think these things, like, they look cool and the beta testers really like them, but I don't think the masses really need a whole bunch more gadgets because, they already have so many. I think it's going to be tough selling another gadget or two to a large group of people.
Yeah, and I can give you some stats on that, which is interesting because I'm familiar with the industry where wearables is a new industry, but it's now like 2 years old. So now there's patterns, right? People are tracking them. And it was an interesting stat, again, at the Consumer Electronics Show where I talked to a lot of experts in this industry. 70% of people that wear wearables or the watches to track their health no longer use them. And it's an amazing stat because you say, well, why? Why is that possible? It's because if you think about these things measure your heart rate, how many, 10,000 steps. But if you're doing this all the time, you start knowing your workout. You know what 10,000 steps is. You know your heart rate when it goes higher. I work out. I could guess within 5 beats of where my heart rate is because, you're working out all the time. So it's an interesting stat. If you go back and I always say this, look at Google. This way you don't have to take my opinion. You should be doing your own research. Look at the projections for the wearables 3 years ago and look at them now. Almost every one of them have been cut in half. And you look at Apple and you say, wow, yeah, Apple, that's a huge growth component. They're basically making 15 million of them, right, of these watches the first year. Let's say if they make 50 million over the next 2 years and sell them for $500 each. I mean, you're talking about, $20 billion, $25 billion market. And again, you're looking at a company like Apple. It has to generate $250 billion in revenue. So even if they make 50 million of these watches, which is an outrageous number, and again, Apple's a great company, and I love it. I own Apple products. I'm not going to buy the watch. But even if they have a lot of those people buying that product, an average price at $500, and they're selling their cheapest one for $350, I mean, even if they do great on that product, it's $25 billion for a company that needs to generate $250 billion in revenue. So it's something to think about if you want to buy Apple stock here. I just don't like it. I wouldn't say to short it. I just think there's better alternatives than buying Apple here, especially since I've been bullish on the stock since 2010. It's up like 300%. I took profits.
Yeah, Apple's gotten so big. I mean, it's very tough for them to move the needle now, even if they have, winning products. I think it's been that way for almost every company that's gone to almost $1 trillion in market cap, right? They've become victims of their own success where, even if they have a win, it's not big enough to move the needle anymore. Yeah,
I just feel like this move was also forced. I mean, it was an exciting conference. It wasn't that good, the whole Apple launch and everything with the watch and what it's going to do. It just wasn't really exciting to me. It didn't make me want to go out and buy a watch as someone who owns Apple products. It feels like they have to get into these markets. They know about it. But, one thing if I would do with Apple, they have a ton of cash. Instead of buying back stock and raising their dividend, which I know is a short-term fix, and I know the icons and so many people like that because the stock goes up, it gives them an opportunity to sell. I'd be acquiring some of these companies with amazing technology. Guys they must see so many different technologies come across their desk or people saying, hey, this is pretty cool. We'd love to partner with Apple, with Beats. They bought Beats, $3 billion was nothing. They have $150 billion in cash. I'd start acquiring a lot of these companies with great technologies, and that's where Apple could take an advantage. But right now, again, I just see growth slowing unless something happens, and I'm 100% wrong on the watch, which could be possible.
Yeah, I'm not as bullish on the watch, but I think some people like it, but I think it's going to be a tough sell to the masses because when I just look at the real economy, I just don't see a lot of people in the middle class in the United States with as much discretionary income as they had a number of years ago. But that's just the way I view things now. Is maybe they'll put it on a credit card or something, and maybe they'll worry about paying it off later. But anyway, though, my last topic here, Frank, you have a new newsletter out on your website about a venture capitalist. It's about, I think, foreign stocks, right, and resource stocks. It's
resource stocks, not really foreign stocks. I mean, North America, the resource stocks that we pick, since we have great connections like you to Rick Rule and so many people. Most of those trade in Canada right now, and it's basically a newsletter that is I'd say a high risk, high reward newsletter, but we do have stop losses, so I wouldn't say too high a risk. But we look for stocks that could go up more than 300%. I've had a great track record of having this type of newsletter over the past 10 years. With a lot of 100% winners. 1 in every 5 of my stocks had triple-digit gains over the last 3 years in my newsletter. So this is a fantastic newsletter. A lot of hedge funds have this newsletter as well, and these are just ideas from me traveling all over the world, having my podcast, Wall Street Unplugged, which just like you interview people, you learn from people, you have them as contacts for the rest of your life. I've been doing it for 10 years, and now I've interviewed thousands of people. So just through my contacts and everything and different ideas and the feedback you get, right, Jason, from your audience, it's just amazing how many people this has a global reach, and you just get a better perspective of things, and you have a huge contact list, and that helps me find really good ideas before everybody else, and also helps me realize when trends aren't that real, like the wearables trend, which I was kind of excited about, but now I look at the stats and talk to the guys, the real guys in technology that follow this, that actually invest in trends like this. They're not too excited about the wearables trend. They don't think it's going to be that big, and that's where I really find my new ideas for venture capitalists.
Yeah, those are great points. I'm actually, in technology, I'm more bullish on like 3D printing and robotics and cybersecurity and stuff more than wearables. I think, those are potential enormous disruptors, where the human being will become they'll become a lot more productive, but we won't have to do as much physical labor, and we'll be able to, do a lot of more business online and e-commerce and things like that. Wrapping up this interview, Frank, I just want to thank you for your time. I really enjoyed this discussion. Did you tell our listeners exactly where they can find your podcast, either on iTunes or on your website?
Oh, yeah, you can go on iTunes. You go on www.frankcurzio.com. You can find my newsletters there. I also have another newsletter, Disruptors and Dominators. It's $49 for the entire year. I keep that price low. This way I can provide real quality research for everybody out there to actually see my research. It also has a 30-day money-back guarantee. So you can subscribe and say, well, this isn't for me, and we'd give you your money back. But a lot of people who take advantage of that offer usually stick around. And you know how this business is, it's not just about having a couple of gains on monthly or coming up with a couple of ideas. We want our subscribers and everybody to listen to us for 10, 20 years, and that's how you build relationships. So I appreciate you giving me a chance to plug that. But that's www.frankcurzio.com. You can find all that.
Yeah, exactly. Rather than, just trying to monetize every person and maximize every single sale, it's more about trying to maintain long-term relationships with people and build customers for life. Yeah, I think that's a lot more important.
Yeah, exactly.
Well, again, thanks for your time, Frank. Hopefully I can have you back every couple months. I really enjoyed this discussion. I learned a lot from it about the technology industry and your views on buying growth stocks that are still value, so I really appreciate it.
I appreciate it, man. Thanks for the opportunity.